Hi, I'm Debra Rudd, and welcome to the Hodgin Law PC International Tax Lunch. We do this almost every month on the last Friday of the month, 9 a.m. Pacific Time. Listen in online or watch the show later on YouTube. This month's topic is Pre-Expatriation Tax Planning to Minimize Exit Tax. Today we're going to go over how to help clients renounce U.S. citizenship or end long-term residency while minimizing exposure to Internal Revenue Code Section 877 Cap A exit tax. Let's get started. We're going to go over a little brief introduction where I talk about context and framework for this discussion. We'll look at what expatriate means under the tax definition. We'll look at how exit tax works, a brief overview of common planning techniques for exit tax, and then we'll look in detail at three of those techniques. One is don't expatriate, one is don't be covered, and another is minimize exit tax. We'll also take a look at some situations where things get a little tricky in the planning, and that will pretty much wrap us up for today. So first, a little bit of context and framework. When I'm talking about the word expatriate, what I'm talking about is the tax meaning of the term, not just a U.S. citizen who's living abroad. The tax meaning of expatriate is someone who terminates their citizenship or their long-term resident status as described under Internal Revenue Code Section 877 Cap A G2. Why people expatriate, the reasons that I see are kind of two categories. A lot of it's practicalities, tax compliance burden, foreign banking headaches, cross-border tax complications. These just take time and bandwidth and cause stress. There's also emotional drivers. People might desire simplicity, lower stress, better life, matching citizenship status to identity. I see all of these types of situations. Usually, it's at least 2 or 3 or 4 or 5 of these reasons that cause somebody to actually expatriate. When you expatriate, the IRS wants some things from you. First is paperwork. You have to file Form 8854 for the year of your expatriation. Often, but not always, you're filing a dual status tax return for that year. And for covered expatriates, there's an exit tax. You may or may not be subject to it if you're covered, but you definitely might be. This is covered under Section 877 Cap A. And the IRS also attempts to close estate tax loopholes for covered expatriates, and they do this through Section 2801, the tax on covered gifts and bequests, which now, I think starting this year, 2026, for the year 2025, I think we're going to have a Form 708 where we can actually report these things for the first time. In terms of how expatriation works, what you have to have is the right set of ingredients. So you have the right type of person. That's either a citizen or what's called a long-term resident. And a long-term resident is just someone who has had the immigration status of being a lawful permanent resident for a long enough time. That makes them a long-term resident. So either a citizen or a long-term resident has an expatriation event where they terminate that status of citizenship or long-term resident. That makes them an expatriate. When they're an expatriate, there's 3 tests for covered expatriate status, and either you pass, in quotes, those 3 tests and you're not a covered expatriate, or you, quote, fail those tests and you're a covered expatriate, and then you're paying exit tax. So let's take a look at what the term expatriate actually means. This is defined in Section 877 Cap A G2. This is any United States citizen who relinquishes his citizenship and any long-term resident of the United States who ceases to be a lawful permanent resident of the United States within the meaning of Section 7701 B6. So for citizenship, this one is fairly straightforward. You're a U.S. citizen, you stop being a U.S. citizen. You're an expatriate. What about long-term residence? Let's break this down a little bit. A long-term resident is someone who's had a green card for a long enough time. This is defined in old section 877, not Cap A, 877E2, as any individual who's a lawful permanent resident, that's green card holder, of the United States in at least 8 taxable years during the period of 15 taxable years, ending with the taxable year during which the individual ceases to be a lawful permanent resident. So let's put this into plain English, because this is a long sentence or a long phrase. The easy way to look at this is they're saying green card holders who had the green card during 8 or more of the last 15 years. If that's you, you're a long-term resident. And this could be, because it says the word in at least 8 taxable years, what it means is during 8 years. So if you've had the green card, starting December 30th, that counts as 1 year. So you have 8 of those, that makes you a long-term resident. And then if you terminate your green card at that point after you're a long-term resident, that makes you an expatriate. The most common expatriation events that I see, renouncing United States nationality before a diplomatic or consular officer of the United States, that's U.S. citizens giving up their citizenship, filing Form I-407 to abandon lawful permanent resident status. This is where you just mail in this form along with your green card, and that terminates your green card. But it's important to note that letting the green card expire, that is not an act of expatriation. Another common thing I see for expatriation is expatriation by treaty election. This one's not quite as common as the first two. This applies to green card holders only, and it can be done only after long-term resident status has been achieved. So only after you've had the green card in 8 of the last 15 years, you then make a treaty election to elect non-resident of the U.S. under the tiebreaker rules of a treaty with another country, and that itself will be an act of expatriation. Interestingly, if you do it before you meet the long-term resident test, it's not an act of expatriation, it just removes that year from the 8-year count. Now, let's talk a little bit about exit tax. Only covered expatriates have to pay exit tax. It's not just exit tax. It's also Section 2801. Their U.S. heirs are subject to an inheritance tax. Whereas non-covered expatriates, there's no exit tax, and they don't have to worry about Section 2801 for their heirs. So everything hinges on whether you're covered. Everything we're talking about today. Exit tax, covered. No exit tax, not covered. And to tell if you're a covered expatriate, you have to look at these 3 tests for covered expatriate status. They're basically financial tests. The first one is the net worth test. If your net worth is $2 million US dollars or more, you're covered. Tax liability test. If your average tax liability for the 5 years before your expatriation year is $206,000 or more, that's the 2025 amount, then you're covered. Or if you didn't meet all of your tax obligations under Title 26 for the 5 years before your expatriation year, you're covered. So if you pass all 3 of these tests, that would mean your net worth is below $2 million, your average tax liability is below $206,000, and you did meet all your tax obligations under Title 26. If that's the case for you, then you're not a covered expatriate. I have a little flowchart here that I've used a number of times. I think it's pretty helpful. So let's say you're going to be an expatriate, and you should obviously, or maybe not so obviously, but you should look at this before you expatriate to see whether you're going to be a covered expatriate and see whether you're going to have to pay exit tax. So you start out and say, all right, I'm going to be an expatriate. So let's see if I'm going to be covered or not covered. First step, do I meet the certification test? You meet this test if you have met all your obligations for the prior 5 tax years. So if the answer to that is no, you're immediately not covered. you're immediately covered. No on-certification test, you're a covered expatriate. And there's a couple exceptions we'll look at in a second, but neither of those exceptions can be used if you don't meet the certification test. So that one's a deal breaker. So let's say you do meet the certification test, you move forward to the next step in the flowchart. Then you can check if an exception applies. There's two exceptions, either dual citizen at birth or age 18 and a half or younger at the time of expatriation. If you meet those, you get to skip over the net worth test and the tax liability test, and you're not covered. But if neither of those exceptions apply to you, then you have to go through the net worth test. If you're below 2 million, you keep going. If you're above 2 million, you're covered. Then you look at the tax liability test, and if you meet that one in addition to the certification test and the net worth test, then you're not covered. But if you fail just that one, then you're covered. So all you have to fail is one test to be covered, but you have to pass all three to not be covered. And if you're covered, you have to look at exit tax. You probably have to pay exit tax, but maybe not. So what you do if you're subject to exit tax is you follow this rule. All property of a covered expatriate shall be treated as sold on the day before the expatriation date for its fair market value. Now, the term all property is defined in Notice 2009-85. And they define this as any interest in property that would be taxable as part of his or her gross estate as if he or she had died on the day before expatriation. So when we're looking at all property, we look at, let's pretend they were a citizen or resident of the United States. They died the day before expatriation. What would be included in their gross estate? All that stuff is going to be subject to the deemed sale. This deemed sale exit tax applies to most assets because most things are going to be includable in the gross estate. For the sale price, you use the asset's fair market value. For basis, whatever the adjusted cost basis is under the normal tax rules, and you get an inflation-adjusted exclusion that can be applied proportionally across all your gains of $890,000 per expatriate, not per married couple. So each individual gets $890,000 exclusion. That's the number for 2025. It's going to go up again for 2026. Now, there's also some special exit tax rules for certain types of assets. And so these are kind of carved out from the normal deemed sale rules. If you have deferred compensation, and this will be things like foreign pensions, but also 401ks, you can have it either eligible or ineligible. If it's eligible, that means you pay as you go 30% withholding on distributions and taxes calculated under the normal rules. If it's ineligible, which is true for most foreign pensions because under the definition of what ineligible deferred compensation is, typically foreign plans are going to be ineligible. Then you have a deemed lump sum distribution on the day before expatriation. Specified tax-deferred accounts, these are things like IRAs, and there's a bunch of other stuff in that category, but that's the main one I see over and over. That one's also a deemed lump sum distribution on the day before expatriation, so very similar to ineligible deferred comp. And then if there's a beneficial interest in a non-grantor trust, you have pay-as-you-go 30% withholding. So most things are going to be caught in the net of exit tax. They're going to be includable in your gross estate, and then there's special rules that apply to certain types of assets, mostly retirement accounts and a little bit in non-grantor trusts. And so basically everything you own, you can expect to get caught up in exit tax. So people who are facing the decision to expatriate and potentially facing exit tax often want to do some planning for that. And there are a few ways to either avoid or lower exit tax as much as possible. The first is don't expatriate. If you're not an expatriate, you are not facing exit tax. The second is go ahead and expatriate, but do everything you can to make sure you're not covered. Make sure you pass the certification test. Make sure your net worth is low enough. Make sure your tax liability over the last 5 years was low enough. The third option, which I see more and more as time goes on and as 2 million net worth becomes a smaller and smaller number, the third option is to accept covered expatriate status, but lower the exit tax as much as you can. And then technically there's a fourth option. You can just expatriate and not worry about it. I've had a couple clients do that, and they just deal with whatever the tax consequences are after they go ahead with it. Usually they have some idea of what they're getting into, and it's not a completely random decision. So just a little illustration here. If you're going down this road of deciding what to do, you can not expatriate. This keeps your life simple in terms of exit tax planning, but it means you have ongoing U.S. tax compliance. If you expatriate but avoid covered status, you avoid the exit tax. That's great, but it often requires planning, and sometimes the plan can get kind of complicated and can take some time to implement. And then lastly, if you want to be covered or you can't avoid covered status and you're just trying to minimize exit tax, the obvious drawback here is that you're going to have tax exposure if you go through with it. So in terms of how to form a plan for exit tax, you want to look at the entire life cycle of an asset in an expatriation scenario. So let's say you are a married person, you have a spouse, and you're thinking about giving away assets to your spouse. So first thing you need to look at is, would it be subject to gift tax? Can I even give this asset away? Is it even practical? Gift tax can be a much higher rate than exit tax. Then you look at exit tax. If you're keeping the asset, what's going to be the exit tax result for that asset? Also, if you're keeping it, you might have to deal with post-expatriation income tax. The rules are going to be different. You're no longer going to be taxed as a resident. You're going to be taxed as a non-resident after expatriation. And then if it's a U.S. asset, you might have to pay a state tax on it, or your state does when you die. Or if it's not a U.S. asset, or even if it is, but if you're a covered expatriate, there might be an inheritance tax for your heirs if they're U.S. people. So for every asset on your balance sheet, you basically want to trace all the outcomes through each stage for every single asset. And let's talk a little bit about optimizing for exit tax. Optimizing, for one thing, usually means compromising some other thing, just how it generally works. So each time you adjust one area of your plan to avoid or minimize exit tax, make sure to check for ripple effects. Each adjustment you make, look at, all right, now that I've changed, how this asset is held or what I'm planning to do with it long term, what are the ripple effects? What's going to be the income tax results after expatriation? What are the paperwork filing requirements? How does this play out for exit tax? And keep in mind, exit tax is not as bad as gift tax or Section 2801 tax. It's typically at a lower rate than those other taxes, so it might not be the worst thing. So don't create a higher overall tax burden just because you want to avoid exit tax at all costs. It's important to weigh each of the options against each other. So let's take a look at the first exit tax planning technique, which is don't expatriate. You do not have to pay exit tax if you do not expatriate. So how to not expatriate? Most of us are usually doing a pretty good job of not expatriating on any given day. It's much harder to expatriate. So you keep your U.S. citizenship. If you have a green card and you're reaching a point where maybe you want to spend more time out of the U.S., one option potentially might be to apply for U.S. citizenship instead of terminating it. That gives you greater freedom with traveling around the planet and not having to worry about meeting all the residency requirements for keeping your green card. Another option could be to terminate your green card before you become a long-term resident, and I've worked with a ton of people who have done that. As long as you terminate the green card before you become a long-term resident, before you have the green card during 8 of the last 15 years, then it's just a switch of status. You're just changing from U.S. taxpayer to U.S. non-resident taxpayer, and there's no expatriation event, so you're not an expatriate. So for people who are choosing to remain citizens, usually when people are looking at expatriation, kind of kicking the tires, but they end up keeping their citizenship, what they end up doing is trying to restructure their assets and income to create a simpler worldwide tax situation. That's usually one of the problems they're trying to solve by considering terminating citizenship. So make their lives simpler, make their worldwide tax situation flow a little more seamlessly between whatever countries they have to deal with other than the US. And then the other thing is estate planning, because US citizens, their worldwide assets will be subject to US estate tax. So it's a good idea to take a look at that as well if you're going to be keeping your US citizenship. For green card holders, the option of avoiding expatriation but terminating the green card, there's a couple ways to go about this. You could toggle years on and off for long-term resident status using treaty positions. I mentioned this a few slides ago, a little while ago. This only works if you haven't accumulated 8 years yet and you haven't become a long-term resident. So if you have less than 8 years, you've only had your green card during, let's say, 5 years, you want to terminate it right now, fine, you're not going to be a covered expatriate. The other thing you can do is make a treaty election. So if you're living in another country for an entire calendar year and you make a treaty election to elect non-resident status in the US under the tiebreaker rules of that treaty, that will remove that year from the 8-year count. So you can use that potentially to eliminate years from the 8-year test. And then before you hit 8 years that count toward that test, you make sure to file the I-407 and turn in the green card. That creates a situation where you have a simple conversion from resident alien to non-resident alien for income tax purposes, and you would not be an expatriate, so you would not have any exit tax. And then sometimes the solution is to go completely in the opposite direction. So if you're a green card holder and you're considering terminating your green card because of whatever various reasons in life, sometimes the better option could be to get US citizenship, especially if it's not a very challenging application. A lot of times I see people do this when one spouse is already a US citizen, the other's a green card holder, and so sometimes the green card holder spouse decides to apply for US citizenship. Obviously, if you do that, the US tax filing burden continues forever until you turn in your citizenship. But you also get the unified credit for estate tax and the freedom to travel and live anywhere without having to worry about your immigration status in the US changing. You don't have to pay exit tax, and you don't have to deal with any Section 2801 tax. So for some people, this ends up being actually the solution to the problem. The second strategy that I think is worth looking at is to not be covered. This is the one that most people want to accomplish when they work with me to plan for exit tax. So what you do is you basically just very, very carefully evaluate your status for the 3 tests for covered expatriate status and do whatever you can to pass all 3. And if you're successful at passing all 3, then you can avoid being a covered expatriate. So you do this by looking at each test. Certification test. If you need to, you amend your tax returns, pay any tax, penalties, interest, include any unfiled information returns, or fix any information returns that are missing any information. Then you look at the net worth test. If your assets are worth more than $2 million, you're going to be a covered expatriate. So maybe you can make some gifts. Occasionally, I've had clients who decide to sell an asset because they're just over 2 million, and if they sell and pay tax on the gains, that'll get them under 2 million. Tax liability test. You can switch to married filing separate status, because when you're married filing joint, you don't get to divide the tax liability number by 2. So you can manage your total tax liability on your tax return by switching status. You can potentially earn less income, pay less tax for long enough to bring your 5-year average down. So I want to spend a little bit of time going into detail about each of these methods for looking at each of these 3 tests. First, certification test. The certification test applies to any expatriate who fails to certify under penalty of perjury that he has met the requirements of this title for the 5 preceding taxable years, or fails to submit such evidence of such compliance as the Secretary may require. What are they really saying here? Of this title is Title 26. Title 26 contains the rules for income tax, gift tax, employment tax, information returns, etc. Interestingly, it doesn't include the requirement for the FBARs. So a little bit of a technicality there if your FBAR filings are not up to date, but everything else in your tax returns is okay, you might still be able to meet the certification test. However, there's no guidance on this test. There's no regulations. There's nothing in Notice 2009-85. There's no de minimis rules. And I take that to mean that the IRS must want you to file amended returns with $3 due because you forgot to include $10 of interest income on a tax return. Obviously, that's kind of an extreme example, but I've had many clients amend a return to fix a tiny trivial issue like that prior to expatriation. So how do you approach this test? I tend to be pretty careful about it. You report all unreported income, even the little tiny amounts, fix or file any information returns if you made a mistake or didn't include them, pay all tax, penalties, and interest, and when you're thinking about what to fix, the way I think about it is the small stuff, it's very easy to fix, so why not just do it because you can eliminate your risk. And the big stuff, you really need to fix it if you want to be able to say yes on Form 8854 when you answer the certification test question. So really, you should fix everything before you expatriate. The common certification test problems that I see are number 1 is foreign retirement accounts. Often these require Form 3520 or 3520A, or income inclusions or treaty elections on Form 8833 to avoid income inclusions. Very often unreported bank accounts or other accounts. Getting community property wrong on married filing separate returns. Information returns for foreign corporations, partnerships, or disregarded entities, Form 5471, 8865, 8858. PFIX not reported on Form 8621. Foreign gifts and inheritances not reported on Form 3520. And I didn't even say it here, but also foreign trust reporting on Form 3520 and 3520A is fairly common as well. In terms of mitigating penalty risk, so let's say you need to amend some tax returns to make sure you meet the certification test before you expatriate. You might be someone who has errors on your information returns, or maybe there are some information returns you didn't even file. Maybe you didn't know you needed to. Lots of situations, all kinds of fact patterns, a lot of different things are possible. So the first thing you want to do if this is you need to assemble your team. You need a CPA for tax prep, and often, in my opinion, I think you usually need a controversy lawyer for the filing strategy. because a lot of times you're dealing with situations where you might have an information return to include or correct, and you're facing potential $10,000 penalties for each year that you need to make corrections on an information return. So you probably want a controversy lawyer for the filing strategy and to talk about penalty mitigation. Streamlined procedure is often a good option unless there's willfulness factors, and that can be used for 5 years of tax returns to cover the certification test. Personally, I've done that a bunch of times. Even though the IRS website says it covers only 3 years, you can include more years of tax returns through that program if you want to. And another thing to think about is it a good idea to have attorney-client privilege? Consider getting a lawyer involved early, a Covell agreement for the tax preparer. This is a question I can't answer for you if this is a protection that you need. It's just something you need to talk to a professional about and get advice for. But the bottom line for the certification test, you're answering the question on Form 8854 about whether you've complied with all your tax obligations under penalty of perjury. So saying no to that question invites an audit at minimum, possibly worse, I don't know. You can't lie on that question because it's penalty of perjury. And your goal is to extricate yourself from the U.S. tax system cleanly and on no uncertain terms. So if you have gray areas or things where you're not sure if you really need to fix something or how to fix it, that's really where you really want to talk to a tax lawyer. And just a little checklist here to make sure that you pass the certification test. Amend prior returns, no de minimis exception, file missing information returns, fix FBAR related overlaps tied to Title 26. So let's say you need to correct your Form 8938, which gets filed with your tax return so you can meet the certification test under Title 26. Well, you might have a corresponding fix to make on your FBAR. And so usually when someone's amending tax returns with an FBAR related issue, we also go ahead and amend the FBAR at the same time. Generally recommended because, you report the things on the 8938 and you're giving all the information about what's not reported on your FBAR by doing that. So typically you want to sync those up if you can. Address any community property misallocations, deal with foreign pensions and retirement accounts, and just keep in mind if you're going to fix one thing on an amended return, you have to fix everything that's wrong with it. You can't just pick and choose, and especially when we're talking about the certification test where we don't have any de minimis exceptions and no carve-outs or things that don't apply, so you fix everything. Next, let's talk about the net worth test and how you can plan to meet the net worth test so you can avoid covered expatriate status. When you're looking at the net worth test, the basic question is, what do you own? And we're talking about a personal net worth, so you look at your personal assets and liabilities, and if the number is above USD 2 million, then you're covered. If it's below, then you're not covered, at least not under that test. You do a separate calculation for each individual, so you do not include your spouse's assets. That means you need to understand within the marriage what each spouse owns. So you have to consider marital property laws, pre- and post-nuptial agreements, trusts, anything that might modify the pure title ownership or, whose name is on the bank account. Liabilities are typically split 50-50 between spouses, even if there's joint and several liability. That's actually the more conservative way to look at it because you're subtracting liabilities from assets. Managing net worth with gifts. This is by far the most common way that people reduce their net worth before expatriation. You can give gifts to humans or to trusts. If you give a gift to a human, be careful of the rules around gifts to spouses. if you give to a trust, watch out for Section 684, which can cause gain recognition in certain situations in trusts. And if you are making gifts and you're relying on the unified credit to avoid gift tax, that means you're going to need to wait to expatriate until the following calendar year. So let's say you make a gift in June and you want to expatriate in November. Even though you're expatriating after the gift in the same calendar year, whether you get the unified credit depends on your status on the last day of the year, December 31st, and you'll be a non-resident alien not domiciled in the U.S. on that last day of the year if you're expatriating in November, so you would lose the unified credit for the gift you made in June. So if you want the unified credit, you make the gift in 1 year and you wait until the following calendar year to expatriate. And what this typically looks like before gifting, let's say someone has 2.4 million of assets. We have a $2 million threshold. They need to get below that. They manage to give away $600,000 of assets, and after gifting, they have 1.8 million. They can then go ahead and be a non-covered expatriate after those gifts. If you're giving gifts to a spouse, if it's a gift to a U.S. citizen spouse, you can rely on the unlimited marital exemption. Gifts to a U.S. citizen spouse are subject to that exemption, and they're tax-free for gift tax. If you're giving to a non-citizen spouse, there's an exclusion amount each year of $190,000 for 2025. It'll go up a little in 2026. But if you're domiciled in the U.S. and you can wait until the following year to expatriate, you could give up to the unified credit amount. Even to a non-citizen spouse, you just have to file a gift tax return and claim the unified credit. So, I keep mentioning this. If you expatriate in the same year as the gift, the unified credit goes away, even if you expatriate after the date of the gift. So just as much caution as I can possibly give about that one fact. And let's take a look at the classic spouses gifting back and forth situation. So the first spouse, this is a scenario for when both spouses want to expatriate. So the first spouse gives assets to the second spouse, then the first spouse expatriates. Later on, the second spouse wants to expatriate, so they give assets to the first spouse, then they expatriate. Now, both spouses are non-resident aliens of the U.S., and after that, they can decide what to do among themselves. This scenario works if the gift tax rules in the U.S. and any applicable foreign country align with your goals, if the gifts are real gifts, if enough time passes, etc. You don't want to mess around with just transferring an asset temporarily and then getting it right back. Make it a real gift. Do the paperwork. Change the title. If you're transferring money, transfer it to that other person's bank account and leave it there. Make it a real gift. This does not work if most of your net worth is in non-transferable assets like retirement accounts, pensions, etc. And as I said a moment ago, the gifts must be gifts. You can't have any strings attached. The IRS could say, nope, that's not a real gift. Or you might have gifts where Section 2035 applies, which talks about retained interests. You can't retain interests. Typically, that's going to pull it back into your exit tax calculation. So when you're doing this, transfer titles as applicable. Do that with real estate, airplanes, boats, etc. Set up a new account in the recipient's name for financial gifts. File any gift tax returns. Pay any gift tax or transfer tax. Recipient reports and pays tax on the income from the gifted assets after the gift because it's their asset. It's their income moving forward. The passage of time solidifies gifts as real. If someone gives me $100,000 and then I give it back next week, maybe it wasn't a real gift. If someone gives me $100,000 and 3 years from now I still have it, it looks a lot more like that was a real gift. And gifts are not the answer for all situations. There can be some situations where maybe there's a high foreign transfer tax or gift tax on foreign assets. There could be citizenship or residency issues that severely limit the time that someone has available to give back and forth and then expatriate. So making gifts might not be feasible in that situation. I've worked with some people who had concern that their spouse would take the gifted assets and run away and never come back. So that wasn't a good solution for those people. And if you have a priority on fast expatriation, avoiding double tax, or avoiding estate tax over avoiding exit tax, then maybe in that situation, gifting is not really what you want to be looking at. You're not trying to avoid exit tax. You've got bigger problems. And then also there's some situations where someone's expatriating, but they don't have anyone to give anything to, so they just accept the exit tax. Other than gifts, there are other net worth reduction ideas. I think I mentioned at one point I've had some clients sell their assets and pay the tax, especially if they're just over $2 million and they were going to expatriate anyway, and that tax will get them below. That can work. I've seen people take distributions from U.S. retirement accounts and pay the tax. And this could be useful for people who want to own no assets in the U.S. after expatriation and are close to the $2 million net worth. If you're going to be reducing your net worth prior to expatriation, there's going to be some information reporting. Maybe you need to file a gift tax return in the US or in another country, I'm not sure. But in addition to that, Form 8854 asks you about substantial changes to assets and liabilities, and that applies even in situations where a gift tax return is not required, because it doesn't say, did you make a gift where you had to file a gift tax return? It says, have there been significant changes in your assets and liabilities for the 5 years ending before the date of your expatriation? And in the Form 8854 instructions, the IRS clarifies that gifts to reduce net worth to below $2 million must be reported on Form 8854. And starting with the 2024 form, there's a new box to check. You would have to check yes on that question that I copy-pasted into this slide. Now let's take a look at the tax liability test, the third test. What the law says. This applies to anyone where the average annual net income tax, as defined in Section 38C1, of such individual for the period of 5 taxable years ending before the date of the loss of United States citizenship is greater than $124,000. And the flush language in that section instructs us that the amount is indexed for inflation, so the $124,000 for 2025 is actually $206,000. And just to clarify, the misconception I hear a lot of times is people say, oh, my income, yeah, it was over 206, I guess I'm covered. It's not your income. The number is your tax. This is asking if you paid, on average, more than $206,000 in income tax, not whether you had $206,000 in income. So how do you calculate your number? The easy way to do it is to take the prior 5 years of tax returns, find the total tax line, take the number from each of those lines, add them up, and divide by 5. That'll give you kind of a quick calculation of your average tax liability. The more detailed way is you can go read Section 38C1, and it defines net income tax to mean the sum of the regular tax liability and the tax imposed by Section 55, reduced by the credits allowable under subparts A and B of this part, etc., etc. And you can trace that through and see exactly what items go into the net income tax. Just a little preview. You can subtract the foreign tax credit. So if you're using foreign tax credit to reduce your tax, you take the amount after the foreign tax credit's applied. And you do that math for each year, you add up the prior 5 years and divide by 5. So what I suggest people do is first do the easy way, take the 5 years, divide by 5, and if you're well under the 206, then you don't really need to go through the more detailed calculation. It's only if you start to get close to that number or up above that number that I would suggest going through the more detailed method of calculation. For married couples, if you are filing joint income tax return, and each individual spouse needs to know their average tax liability, you do not divide the number on the married filing joint returns by 2, you count the entire amount. This comes from IRS Notice 97-19. It says an individual who files a joint income tax return must take into account the net income tax that is reflected on the joint income tax return for the purposes of the tax liability test. So an individual takes the net income tax from the joint tax return. And to mitigate the tax results of this, you could switch to married filing separately and do that for some time, maybe a year, maybe 3 years, depending on how much income you make versus what your spouse makes. Other planning ideas for the tax liability test. You can earn less income, and if you do that long enough, it'll bring your tax liability down. You can do this especially if you run your own business and you can decide how much work to take on. Another thing to keep in mind is the tax liability test covers only the 5 years before the expatriation year. And the quote is, it's for the period of 5 taxable years ending before the date of loss of United States citizenship. So if you have a huge income recognition event in the year of your expatriation, it doesn't count towards the test. So you have low income tax for the 5 years before expatriation, big income event in the year of expatriation, and then expatriation doesn't count towards the test. So I've used this timing opportunity many times to help people avoid failing the tax liability test. And that's it for the 3 tests, or at least that's what I have to say today. So let's move on to the third exit tax planning technique, which is to minimize the exit tax. This one gets used when someone cannot avoid being a covered expatriate for various reasons. So maybe they could at least shift some things around so the exit tax bill is more manageable, or maybe even 0. First thing to keep in mind is that if you're a covered expatriate, you get a gain exclusion. The amount used to be $600,000 when the law was first written, but the 2025 amount is $890,000. Now that number is per individual, so married couples get $1.78 million total exclusion against deemed sale gains. Of course, if one spouse owns all the assets and the other spouse owns nothing, you don't really get $1.78 million. The spouse who owns everything gets $890,000, and the spouse who owns nothing doesn't really get an exclusion because they're not even going to be covered, most likely. So also keep in mind this gain exclusion applies to deemed sale assets only. So if you have assets that are in the carve-out rules, like deferred compensation or specified tax deferred accounts, this gain exclusion does not apply to those. Foreign pensions might be excluded from exit tax. This is another way that covered expatriates can minimize their exit tax. Any deferred compensation item to the extent attributable to services performed outside the United States while the covered expatriate was not a citizen or resident of the United States, not subject to exit tax. That comes from 877 Cap A D5, and that is confirmed also in Notice 2009-85, so we have 2 sources for that. So that's one way that you can get some of your assets out from under the exit tax. Another is to shift high appreciation assets without gifts. This can be done in community property states. Married couples can make a postnuptial agreement to assign specific property to each spouse. So maybe you shift high appreciation assets to the non-expatriating spouse. If you do that without gifts using a postnuptial agreement, you can have no gift, no gift tax, no need to rely on unified credit or marital exemption. And this could potentially work for green card holder couples or, anyone who might have issues with gift tax. Note that this only works for community assets, and you can't use it to exchange separate property for separate property. That would be a taxable exchange. It's a sale. You have gain recognition. So tread carefully if you're going to consider using this option. You can also shift high appreciation assets with gifts. So you give away the most highly appreciated transferable assets, accept the consequences of the non-transferable assets. Common thing that people do is set up a trust and fully utilize the unified credit. Another thing you can do in this situation is shift the emphasis. So instead of optimizing to reduce exit tax, you might instead optimize for post-expatriation income tax results, where you're working to eliminate double tax issues, or optimize for estate tax or Section 2801, move into non-U.S. investments, or put U.S. assets in a foreign corporation. Maybe for 2801, maybe your children want to consider expatriating so they can protect their inheritance. Consider term life to cover your unsolvable estate tax or 2801 issues. And maybe estate tax treaties can help you with some of these things. Now, there's a few areas where things get a little bit tricky, and I think that they're worth talking about. One situation I see this sometimes is where people have uncertain domicile status for gift tax. For example, having a green card is a factor to be considered in domicile status. So if you choose to keep the green card because you don't want to pay exit tax yet, but you're claiming to be non-domiciled in the U.S. for gift tax purposes so you can give gifts free of U.S. gift tax, you're kind of claiming to have it both ways, or the IRS could see it that way. So one possible solution is only give away up to the unified credit amount and then wait until the following year to expatriate. So if the IRS claims you were actually domiciled in the U.S., it's not a problem. You can say, okay, fine, yes, I was domiciled in the U.S., yes, my gifts are subject to U.S. gift tax, fine, but I get to claim the unified credit, so there's no gift tax. So one way to approach that situation. Another issue I see a lot is foreign retirement accounts or pensions. Typically, these are non-transferable assets that are going to result in double tax. You have ineligible deferred compensation. That's most of the time what foreign pensions or foreign retirement accounts are going to be. You have a deemed lump sum distribution at the time of expatriation and U.S. tax to pay. Later in the country of residence, whatever that ends up being, when you take distributions, you're typically going to be taxed there. And there's not going to be any foreign tax credit for U.S. tax paid at the time of expatriation. And there's not going to be any basis adjustment in the foreign country for the pretend distribution that you were taxed on in the U.S. So one fix that I've been able to use a lot in this situation is if the foreign retirement account or pension was accumulated prior to becoming a U.S. resident or citizen, there's no exit tax on it. And I pointed to that earlier. There's a section in Section 877 Cap A that specifically says that, and it's also mentioned in Notice 2009-85. Another problem area could be foreign real estate with high appreciation, and it's a similar issue to foreign pensions. Taxed in the U.S. at time of expatriation as if it's sold. Later, there's an actual sale, no foreign tax credit or basis adjustment in the foreign country for the U.S. tax, so you end up with a very high overall rate of tax. Not always a good solution here, but consider selling before expatriating or giving it away if the local gift or transfer tax won't cause a problem. Usually a good option for that is a gift to a spouse or to an adult child. U.S. real estate. If you have U.S. real estate and you're going to be a non-resident after expatriation, FERPTA withholding exemptions and refunds can be a very big pain. There's huge processing delays within the IRS, so consider selling before you expatriate. If it's a principal residence, you get the Section 121 principal residence exclusion. That exclusion is not available for a deemed sale. That may or may not give you an overall better tax result than the exit tax exclusion, so it's worth doing the math on that and figuring out how much paperwork you want to deal with. Also, selling your U.S. real estate, if it's your primary residence, selling it before expatriation can potentially help with your claim of state residency termination. Speaking of state residency termination, states don't have exit tax, but whether the federal exit tax hits your state tax return is a question, so it's best not to be a resident of any state at the time that you expatriate. So, especially if you're expatriating immediately after leaving the US and you lived in a high tax state like California or New York, make sure you terminate your state residency in no uncertain terms before you expatriate. For closely held companies and startups, there's often valuation issues, transfer restrictions that can complicate things, and these are areas of increased audit risk. The solution here is get an appraisal, have that in your file, so if the IRS asks you about the value you used, you have documentation. Cryptocurrency can be a similar asset or a similar issue. Basis is often poorly documented. The asset itself can be extremely volatile. So at any given moment, how much gain do I have to include in exit tax is a real question. And again, the IRS is interested in this area, so there's increased audit risk. The solution here is to keep really careful basis records and maybe consider selling before expatriation so you get a 1099 for 2025 and later at least that tells you exactly what your gains are, so you don't really have any risk of the IRS disagreeing on that. So temporarily hold cash through the date of expatriation and then reinvest in what you want. Just a little summary table here. I'm not going to go over each little point in the table. It just summarizes the things we talked about on the slides leading up to this in this section, so feel free to review on your own time. And that brings us to our summary. We talked about the expatriation overview, what makes an expatriate, what makes you subject to exit tax, common planning techniques for exit tax, and then we talked about the three main options to avoid exit tax, which are don't expatriate, don't be covered, or be covered but pay as little exit tax as possible. And then lastly, we looked at some of the more tricky situations that you end up seeing when you're planning for avoiding exit tax. Lastly, for those of you working with clients on these types of issues, try to put yourself in their shoes. They're solving some really complicated problems with a lot of moving parts. So lead with empathy, or at least I'm finding that that's really, really helpful in these situations. Be ready to handle the intersection of many different tax principles, and keep in mind there are no perfect solutions, only priorities. So you're choosing what to optimize for, and that's gonna necessarily compromise something else somewhere else. So just be aware of all the different moving parts. This presentation is not legal or tax advice. You can't use it to avoid penalties. If you need help, I'm not your tax advisor. Just because you watched this presentation, please hire a professional to help you if you need help. Thanks everyone for participating. I encourage you to email us if you had a question that wasn't answered during the session. The next session will be on January 31st, 2026. The topic will be pre-residency tax planning. If you're not already on the mailing list, please sign up to get the announcement emails about upcoming international tax lunch topics. Go to hodgen.com to do this. If you're already on the mailing list, and you probably are because you're listening to this, please tell your friends. See you again next time.